And so what you're seeing in US markets right now is that the growth of bank holdings of treasuries and agency securities is outpacing money supply very significantly. In other words, it's monetization. That's what's going on. Think about why the gold price is up. Think about why Bitcoin has been a dramatic performer. It's all about monetary inflation that's going on.
Michael Howell, CEO of CrossBorder Capital, an investment advisory firm, author of the book Capital Wars, The Rise of Global Liquidity, and the author of the very popular Substack, Capital Wars. It is so wonderful to welcome you back to the show. Great to see you as always, Michael. Really appreciate you taking the time.
Well, really good to be here, Julia. There's a lot going on in markets right now, so lots to talk about, I think.
So much to talk about, and I feel like, gosh, it's been way too long since we last had you on. I want to say it was back in the spring, and you're right. So much is transpiring in the markets, and so I want to start, Michael, as you know, where we always start, more of that big picture, where we are today, the framework in which you're looking at the world, and I know the global liquidity cycle is so critical to that framework. So let's start big picture, where we are today, the framework, the outlook that you see ahead, what is on your radar these days. And as you know, Michael, on this show, you can take all the time you need to set the table when it comes to that big picture view.
Okay, well, I think the place to start is really with liquidity and the liquidity cycle. And there's a slide I've actually put up that you can hopefully see, which is looking at the cycle unfolding really since the mid-1960s. And this is looking at money flows that are moving through world financial markets over that time span. And it's very cyclical. You can see that. But after all, that's the experience we've had. We've had very cyclical markets over that time frame. Clearly, there's a trend, but it's the cycle that we're really interested in. And really since, 3 years ago, late 2022, in fact, almost exactly 3 years ago, this bull market started with a big upswing in liquidity. Now, as you can see from the graph, we're still in that upswing. The red dotted line is a sine wave that we put on top of that cycle around 2020. So it's had a long history to unfold, as you see there. In other words, it's pretty much unfolded as you have expected with a fairly regular 5 to 6 year cycle. And it looks as if that cycle is pretty close to topping out. We're not there yet. We may have a little bit more to go, but we've got to be thinking much more about the end game rather than the beginning. And the downswing, through 2026 may be a challenging period. So we've got to think about this pretty carefully. This is the cycle of liquidity, let me stress. It's money flow through financial markets. It is not measuring the tempo of economies. And I would say, actually, in reality, since the COVID crisis, we've seen economies flatlining. And I don't think economies have made a huge amount of difference to financial markets over that period. They've been a kind of red herring in many ways, leading people down wrong avenues. And in fact, we've faced an absolutely plain vanilla investment cycle. Everything has gone pretty much according to normal script.
That is such a great framework to look at this. Okay, a couple of things I would love to explore with you further. You talk about how we are late in that cycle. Maybe 2026, it might start to be a more challenging period. But you also note that we need to be thinking about the end game rather than the beginning. Can you walk us through the thinking around the end game? How do you need to think about that?
Sure. Well, in fact, if you look at the next slide I've put up, what I've done is to try and put this in context. So the red line on the chart is looking at the current cycle. The 0 point that we plotted right in the middle of the graph is the low point in liquidity. And that has evolved counting months from that trough as you move to the right-hand side. The black dotted line is an average cycle, averaging the data since 1970. And you can see that, broadly speaking, we're following a fairly normal liquidity cycle. It's not falling. I mean, one's got to stress that, but it looks as if it's sort of laboring to get new highs. And that's certainly the concern that we've got. Now, your question, or the relevant question, is what actually causes the top? What causes the crisis? And I think there's a number of things that we can cite, but I mean, foremost is really what central banks are doing, because central banks have been so instrumental in launching this bull market. And what we want to really understand is what's going to end it. Now, if I sort of shift on maybe a few slides to what's happening in terms of liquidity, I'll come back to the other thing. This slide here is admittedly a schematic diagram, but it basically tells us how the global financial system works. And it shows you not only the upswings, but it also describes the downswings. And the point about the modern financial system is it's integrated, or liquidity is integrated really closely with debt. We live in a debt-dominated world, and I can't stress that enough. It's a really key point. The thing is that the paradox that is behind the whole system is that debt needs liquidity and liquidity needs debt. Debt needs liquidity for refinancing, and liquidity is often built on a collateral base, where that collateral base is high quality government debt, which is used as collateral. Now, if you get any dislocations between those two wings of the diagram, you can get financial crises. Now, the key thing to understand is, and this is a development that has evolved principally since the global financial crisis, 15 years ago or so, it's that something like 80% of all lending in the world economy now is collateral backed. In other words, it has as collateral either real estate value, thinking of the home mortgage case, or if you're looking at financial transactions, the collateral is mostly pristine government debt, such as US treasuries or German bunds. Now, the integrity of those bonds, of that collateral, is really key to understanding the liquidity process. And what we say on the left-hand side there is there are two indicators that everyone can monitor that are pretty good bellwethers of that particular process. One of them is the MOVE index, which is a measure of bond volatility. So if you've got a lot of volatility in the bond markets, then you're going to have a lot of volatility in financial markets generally. And ultimately, liquidity will contract, and that will be a bad environment. The other is, which may be a precursor to that, is to look at something which is a bit wonkish, but is called SOFR spreads. Now, SOFR interest rates are the interest rates that have replaced Eurodollar rates. They're the ones that are really the key interest rate in the whole, not just US system, but the whole world financial system. And they can be monitored daily. And what I'm showing here is the SOFR spread, which is the spread over Fed funds target rate. Now, I'm going to show you that in a following slide, which is shown here. Now, you can see on this diagram a very ragged chart. In other words, if this is a patient's heartbeat or whatever, you can see that they're reaching crisis as we move towards the left-hand side. They're starting to go, those beats are starting to go off the scale. And the reason that that's happening is there are increasing tensions in financial markets. It's becoming more difficult for dealer banks to either provide high quality or get high quality collateral, or provide the liquidity that is needed to undertake those loans. And so what is at risk here is the things like the treasury market could become destabilized. Things like you've heard about the basis trade, which hedge funds are undertaking, could suddenly contract. All these things are really at risk with with high volatility in the repo markets. I mean, this in another way is really the heart of the system. And you can see it doesn't look particularly healthy right now. And that's one of the things that we're concerned about. So it's giving us an early warning sign that liquidity is beginning to contract. And that's dangerous.
Gold keeps setting new all-time highs, but price appreciation isn't the only way to profit from owning gold. Monetary Metals is redefining the future of precious metals investing. Instead of paying to store gold, imagine getting paid to own it. With Monetary Metals, you can earn up to 4% on your gold, paid in physical gold. That's right, your ounces grow each month, not just your paper balance. A yield on gold, paid in gold, means you're stacking more ounces every single month. And you still benefit if gold's prices rise. You're earning more gold every month and enjoying potential price appreciation at the same time. Go to monetary-metals.com/Julia to learn more and see how you can start earning 4% on your gold, paid in gold. Yeah, this is why I love having you on the show, Michael, because you always help all of us learn, and I know this audience loves learning from you. So just to recap, the MOVE Index, which is that volatility in the bond market. We actually the creator of the MOVE Index on the show, that was Harley Bassman, and so for the secured overnight financing rate, really important to pay attention there. You point out that we're seeing these early warning signs. And a couple of things could happen. You could see the Treasury market could become destabilized. Can you elaborate a bit more on that risk and how that might play out, why that's so worrisome?
Yeah, sure. I mean, in fact, what I put up here is the MOVE Index, a chart of that. Harley's a great guy, really worth paying attention to. And this is his baby, if you like, the MOVE Index, which is a measure of volatility across the US term structure. And you can see that that has a normal zone that we've indicated, that grey band at the bottom. And essentially, if it starts to move up appreciably, it's measuring higher volatility in the bond market. And the reason that that's a worry is that if you're thinking about taking collateral to back a loan, the more volatile or more unstable your collateral, the bigger the haircut you're going to ask for from the borrower. And that means that they can't borrow so much. So credit conditions tighten. And what this is basically demonstrating is that the Treasury and the Federal Reserve together, in my view, have been trying to orchestrate a lower MOVE Index. So they've been doing lots of things like running down the reverse repo program, things like Treasury buybacks. All these are attempts to try and rein in volatility because it's such a key variable in terms of leveraging this or enabling the system to leverage upwards. The problem is as we indicated, in the repo markets, you're starting to get a breakdown that may cause bond volatility to spike, and that will cascade. Now, why is this important? Let me go back a couple of slides to this one. Now, this is looking at really the overall problem that economies are likely to face or financial markets are likely to face. And this is looking at the debt liquidity ratio in the world economy, or to be 100% precise, the advanced economies worldwide. Now, what this is showing is a ratio. And what you can see from that chart is the ratio stabilizes. It has an average value that it seems to coalesce around, which is roughly speaking 2 times. So it's saying that the amount of debt in the system for normality or for stability has to be about twice the level of liquidity, or to put it another way, liquidity has to cover half the debt. And the reason for that is that debt needs to be refinanced. In other words, if you take out a loan, it's got to be repaid at some stage. Now, we know the spoiler alert is that debt's never repaid, it's only rolled over. So effectively, this is a refinancing measure. And so if you have to refinance debt, you need balance sheet capacity among your banks or credit providers to refinance the debt. If you don't get that balance sheet capacity, in other words, if there's not liquidity in the system, you get a financial crisis. And all the annotations that we show on the chart are previous financial crises. Coincidentally, they all seem to occur when you've got very high debt liquidity ratios. In other words, when you've got tensions in repo markets or in financing markets. The other side of that story is what happens when you get a very low ratio. When you get a very low ratio, there's excess liquidity. The vent for that excess liquidity is asset prices. And every one of those spikes downwards seems to have coincided with a major bubble in asset markets somewhere. And the big one we've just come through is what I've called the everything bubble, or what is generically called the everything bubble, which has basically launched everything to higher highs. Now, we're enjoying that for sure. But if you look into the future, that is likely to reverse. And it's reversing for 2 reasons. One of them is that the pool of liquidity is being challenged, partly by the Federal Reserve and what the Federal Reserve is doing, which I'll come on to, and partly by the fact that, as this next chart says, there's an increase in the annual debt roll. Now, what do I mean by that? Every year, new debt has to be refinanced. And you're looking at a figure of somewhere between $35 and $40 trillion worldwide to be refinanced in markets every year. Now, as I've said before, financial markets today are dominated by these refinancing flows. It's all about debt refinancing. Forget the idea, the textbook idea, that somehow financial markets provide new financing for capital investment. They don't. It's all about debt refinancing. So this is what we got to focus on. Is there enough liquidity to refinance debt? And what you can see there is the orange bars, which are actual data points, and the red bars, which are extrapolations in the future. And you'll see there's a big bite out of that chart in 21, 22, 23. And that period was one where we had ultra low interest rates following the COVID emergency. Central banks put rates down at near zero, some cases negative rates. And that caused a lot of borrowers to refinance their debt. They termed out debt, to use the expression, and they termed debt out to the later years of this decade. In other words, it's coming back into the system to be refinanced again from 26, 27, 28, 29. And this is the annual change in the debt roll, not the actual amount. This is saying how much each year increases over the previous year. Now, all I'm trying to say here is that we've got to remember that there's an echo effect in the system from what happened during COVID times. And that echo effect is the debt refinancing cycle. And that period during COVID was an anomaly. Everyone will remember that it was an anomaly. But in history, it was the most astonishing anomaly when you start to think about interest rates. When I was at Salomon Brothers, US Investment Bank, we grew up on a book which was called The History of Interest Rates by the former head of research at Salomon Brothers. And that book basically said, it was by Sidney Homer, by the way, that book basically said that in 4,000 years of history, there has been not one example of zero interest rates until we get to 21, 22. And the period, in fact, more generally since the financial crisis, has been littered with very low interest rates. And what does that do? It causes huge distortions in markets. It encourages this whole mentality of taking on debt. And that's the problem we've got. Now that debt is coming up for renewal or refinancing. And that's a problem. So that's issue number one. Issue number two, which is to come back to this point about what the Fed is up to, is here is the growth of Fed liquidity. And what you can see is both the history and an extrapolation as to what's going to happen over the next 6 months, given what the Federal Reserve is telling us and what room they got for maneuver. And what you can see is you're likely to get a significant slowdown in liquidity growth. The last time that happened in size was early 2022, and financial markets were pretty bad during that period. It really took that acceleration in liquidity from the back end of 22, which caused this bull market. Now, what we're saying is you've got to be alert to that slowdown because it's happening. Why is it happening? And I think this is the important thing to argue. It's happening because there is great pressure on the monetary authority, both internally and externally from the Treasury, to say, look, all this QE, all this excess liquidity has not helped the real economy at all. It's caused huge distortions in markets. It's basically caused wealth effects or skewed wealth towards one group in the population. It's unfair and it's not going to happen. And therefore, what is being called upon, or the Fed is being called upon, is to downsize its balance sheet. Now, what you might say is that, isn't that a bad thing for financial assets? The answer is it probably is. Is it a bad thing for the economy? Well, that's another question. But the economy is what Treasury Secretary Bessent is focused on. And what you've got to start thinking about is that the alternative policy that is being pursued now, which is heavy issuance of Treasury bills into the system, which is something he said he'd never do when he was criticizing Janet Yellen, but Hayes picked this up. That expansion in the Treasury bill issuance is what we label Treasury QE. It's a way of getting liquidity in the system, but more importantly and fundamentally, it's a way of directing that liquidity into the real economy. Stablecoin are part of that whole exercise. They're an integral part. And what is likely going on, we think, is that you're getting this emergence of a war economy. I'm not saying here kinetic war, but I'm saying a war economy where strategic industries are being identified and funds are being channeled from the federal government into those industries. And it's being funded through the front end of the yield curve through the bill market. And that is the change that we're seeing. We're seeing a transition from Fed QE to Treasury QE, but it's all about the real economy.
That is fascinating. You're right. He was critical of Janet Yellen doing that at the front end of the curve. Why do you think he's doing it again?
Well, I think that what they're doing generally is they're trying to develop, it's the MAGA line of we're going to develop the economy. We want to make the economy strong and robust. And the way that we're doing that is that we're going to direct spending into key industries. I mean, look at the stake in Intel. Look at what's happening with the onshoring. If you go to the White House website, you'll see that there's a ticker there, which now says every day there's a new deal of onshoring. So far in the Trump administration, the US economy has got $9 trillion of new investment. That's the agenda. But the federal government is engaged in that too. And they're basically using Treasury QE, as we call it. In other words, using bill finance to direct that. And the stablecoin industry will be a key element in that because effectively, stablecoins are a way of monetizing government spending quite easily. In other words, funding government credit. And this is basically a change in dynamics where it's not economics, if you like, that's driving the market. It's more and more government intervention.
That's interesting on the stablecoin front. Can you elaborate? So is that like is that like monetizing the debt, or how does it work exactly?
Well, I think we're going to get caught in the weeds here. It's somewhat wonkish.
Okay,
let me try and explain. If you've got a situation whereby a pension fund or an individual buys government debt, that is effectively a transfer out of savings. So there's no net liquidity creation necessarily in that regime. If you get a credit provider that buys government debt, then what happens is the balance sheet of the credit provider expands and effectively money supply, or it monetizes the deficit. So the key thing here is not necessarily the debt issuance, it's who buys the debt. Now, the key point about bill issuance is that bill issuance is really attractive to credit providers because they like that very short duration security, and they tend to hoover that stuff up with alacrity. And so what you're seeing in US markets right now is that the growth of bank holdings of treasuries and agency securities is outpacing money supply very significantly. In other words, is monetization. That's what's going on. Think about why the gold price is up. Think about why Bitcoin has been a dramatic performer. It's all about monetary inflation that's going on.
Good point. At the beginning of the conversation, when you were talking about liquidity and the bull market that we saw, I guess beginning really 3 years ago, as you point out, it looks like it's getting to the place where it's going to start to top out. We have to start talking about the end game rather than the beginning. And you also point out it's about the money flows, not measuring the temper of the economies, and that a lot of economies have been flatlining. And though a lot of people, the way they've talked about the economy, I guess it's led them, as you point out, down these wrong avenues, and that really we've had a pretty plain vanilla market. I guess my question for you is, I take it you have not been surprised that we've seen, all-time highs in, equity markets, for example. Maybe I just want to ask you, what has been your take on what we've seen in markets? I take it you have not been surprised by the moves.
No, I think, Julia, what we've got to do is separate trend from cycle here. And what we're arguing is that there's a long-term trend in faster monetary expansion. In other words, monetary inflation, as we call it, which will see global liquidity, which is our key measure, trend significantly higher over the medium and long term, and a cycle embroidered on top of that, which is key for understanding tactical asset allocation. Now, the cycle is really what I've been talking about a lot recently, and let me just show you this slide, which really identifies the key points in that cycle. Now, what you have on the right-hand side there is a liquidity cycle that is essentially drawn up in terms of phases. You've got calm, speculation, turbulence, rebound, 4 different regimes. If the cycle is expanding, we say that's risk on. If the cycle is going down, that's risk off. And this is all about liquidity, remember, not the business cycle, it's the liquidity cycle. Then on the left-hand side, there are different asset classes that move with the cycle. Equities do well in the upswing. Commodity markets tend to do well around the peak of that liquidity cycle. Cash or very defensive investments do well in the downswing as liquidity is being withdrawn from markets. Bond markets excel around the trough, and then you get the cycle restarting again. Now, if we look at how that has evolved through this particular cycle, this is a standard template that you see in front of you that we use to asset allocate. It's not always as neat as this, but it's working out, as I say, to the letter. And what you've got is 4 different regimes: liquidity regimes, rebound, calm, speculation, turbulence, according to the phase of the cycle. On the left-hand side, we look at asset classes. On the right-hand side, we look at industry groups. Now, what you've seen since that low point in September of 2022 is an expansion, initially a rebound that favored equities and credit markets. So that's the green lights you see on the traffic lights on the left-hand side. As you move towards calm, equities keep going. Credits start to find it more difficult, more risky. And then by the time you get to the speculative phase, credits tend to burn out first. Equities not bad, but by turbulence, you don't want equities and you don't want credits. Commodity markets tend to pick up around the calm to speculation phase, around the top of the cycle. They're not good in rebound. They're not good in turbulence. And then bonds, in other words, long duration bonds, do well in turbulence. Now, what we've seen through this cycle is absolutely plain vanilla. Equities began strongly, reinforced by credits. You've had industry group performance beginning with things like technology. Look at the right. That's what you tend to find early in the cycle. Financials come through about mid-cycle. We've had some very strong gains from financials and now sort of regionals as you get the yield curve steepening. And then you get commodities and energy picking up. You know, gold mining shares have been stellar through this year. And then the cycle burns out and you get defensive outperforming. Small cap do well at the back end of the cycle, exactly what we've seen. The dollar tends to be weaker later in the cycle, what we've seen. International markets outperform the US later in the cycle, what we've seen. So everything seems to be running exactly on course, as I would say. And economics, per se, has not helped one jot through that period. Now, we think it's a question of understanding where you are in this cycle. And another way to look at it is to look at this chart, which is a chart that we use to describe that asset allocation process more visually in a different schematic. Now, what this is saying is you're shifting through the cycle from deflation to inflation. And we think about this as monetary deflation, monetary inflation. As you move from left to right, you get more inflation. Fixed income markets are valued in that sort of red ski slope. So their valuations drop as inflation starts to pick up. Real assets like real estate, thinking of home real estate here, but equally commercial, gold, Bitcoin, tend to do well as that dotted brown line picks up and inflation accelerates. Okay, so that's the absolute opposite of the fixed income markets. But equities kind of in between. They're like a bell curve. And equities see their highest valuations around 2 to 3% inflation, high street inflation, I'm saying here. And you can see, because we've drawn on that chart, different counters to show where US equities are, where European equities are, where Japanese equities and Chinese equities are. So we're kind of later in the cycle in the US, and think of this as a train, a road train that's sort of moving from left to right, with the US leading, then European equities, then Japanese equities, then Chinese equities. Now, the question to ask is, which have been the really strong performers this year? It's been obviously things like mining, late cycle US stocks, and it's been things like Chinese equities, which are really catching the wind of a big monetization going on in China on that sort of far left-hand side. But China is emerging out of deflation into a more robust inflationary regime, so investors are taking more risk. So what you see here is an absolutely plain vanilla cycle as far as we can see. And it's either going to end because central banks decide they're going to pull the rug away, take the punch bowl away because they fear inflation, or you get some problem in markets causing a trigger in the repo markets because actually there's not enough liquidity in the system. And although the Federal Reserve is still telling us they're going to cut interest rates, my view is that this is actually quite a hawkish cut, because you've got to associate that prospective cut in rates with the rhetoric that's coming out of Stephen Miran, Scott Bessent, even Jay Powell himself, by saying, we want that balance sheet smaller, Fed balance sheet smaller.
Mm-hmm. I take it too, like just looking at that chart there, gold, which is at a new 52-week high today, there's still room to run for gold. Because I want to say, last time you talked, I think you were talking about like 3,600 on gold. We're above that now, but gold has just been on a tear.
Yeah, well, let me address the gold question, because I think it's a critical one, and I think by association Bitcoin as well, because we've got to think about this. Now, if you come to this chart, this is basically telling us something really important, okay? And this is saying that if you look at the chart in front of you, this is showing gold bullion prices in orange, measured on that right-hand scale. And the black line is US real interest rates, actually US tips yields, Treasury inflation protected securities. Now, what you can see is that typically over that period until 2022, they were moving more or less in step. In other words, real interest rates are shown inverted here. So when real interest rates went up, the cost of carry of holding gold was high, because gold doesn't earn an interest rate. And so the gold price goes down, and similarly vice versa. But actually you saw a significant break in 2022, because real interest rates shot up, but so did the gold price. And that thereafter, ever since, they've disconnected. So something really serious is going on. Now, I think that's partly the fact that in February, March of 2022, there was the Russian invasion of Ukraine, as we know, and the G10 economies and the US sanctioned Russia and basically took or restrained Russia's holdings of dollar assets. And that's clearly something which focuses the mind of many other economies. And they say, well, actually, maybe we don't want dollars here. They're political. We want gold. Nobody can sanction that. So that's one reason. But the other reason is investors started to realize that what you were getting was more and more monetization going on. In other words, the federal deficit was growing, and there were more and more attempts to monetize that through what we call Yellonomics, of this sort of funding through the bill market. Now, this is the federal deficit, and this is, everyone knows this data, but this is the federal deficit cumulative through calendar years. The black line is where we are now. The orange was 24, 2023 was red, and the dotted line was 22. So you can see, actually, not a great deal of difference. We're heading towards a 2 trillion deficit again, okay? That's got to be funded. So let's look at the math. And what I did here was to look at the Congressional Budget Office projections to 2052. So we go out into the medium term here. And the orange line is what I call the structural federal deficit. Now, what is the structural deficit? It's basically taking all mandatory spending, so Social Security, Medicare, defense, and I'm assuming defense goes up towards, not to, but towards the 5% NATO target, and interest payments. They're all mandatory things. There's no discretionary element in this spending, and I subtracted US tax revenues. And that's the deficit you get. That blows out. That is a significant worry. Look at the COVID spike. Look at the global financial crisis spike, and you'll see that the trend dominates both of those. The dotted line is debt held by the public, by the private sector, which you can see growing on the right-hand side as a share of GDP. Now, as a heads up, let me say this. If the gold market follows that debt GDP step by step, in other words, you're looking at a real federal debt level in gold terms that is measured in gold, and the gold price moves accordingly, the gold price by the late 2030s would be $10,000 an ounce, and the gold price by 2052 under this basis would be $25,000 an ounce. So
wow.
That sober people up. That's why you need gold in a monetary inflation environment. And if you want to think about Bitcoin, what's the multiple between Bitcoin and gold? Well, currently about 25 to 30 times. So that's where you're heading. And that's why we need to think about asset allocation clearly in this context. And that is what's going on. To look at it more visually, here is federal debt to gold drawn from the the early 1940s. And this is essentially valuing federal debt as a ratio to the world gold stock, and looking at how that shifts. Now, what you can argue there is that if there is a trend and those trend lines are intact, if that orange line, which is the real or the gold value of federal debt, goes down to the lower tram line, what you're looking at is $4,500 an ounce. And if it goes down to that average, which is 6 times, you're looking at $5,000 an ounce. And that's in the short term, notwithstanding the fact that, as I said, the longer term outlook looks really good.
Yeah, even that looks good in the short term. But wow, I'm going to hold on to my gold. I'm not going to move.
You got to do.
Yeah, I've had my gold since 2011, and that was not the best time to buy. But look, I didn't do anything with it, and now it looks great.
You just take a look at that little window, Julia. So it says there, since year 2000, U.S. debt stock has increased tenfold. I mean, that's an eye-watering figure by itself, right?
Yes, it is.
Almost 5 times, but actually, in other words, U.S. debt has more than doubled relative to the S&P. But gold's gone up 13 times.
Wow. Yeah, that's a good point. Let me ask you this, because we have talked about this, but since we've spoken, this channel has grown a lot over the last several months too. So you make a really important distinction between, as you call it, high street inflation. High street is like the London version of Wall Street. High street inflation versus monetary inflation. And it seems like all roads are headed toward inflation, specifically a monetary inflation environment. Could you maybe elaborate or explain the distinctions, and why you need to really think about asset allocation in a monetary inflation environment?
Yeah, sure. Monetary inflation is all about the value of the currency. In other words, are you devaluing paper money or not against real assets? And that's really that's one of the key factors that drives economies. It's that particular relationship. Do you devalue your paper money or your credit money? High street inflation, by the way, that's called monetary inflation if you devalue. High street inflation is a cocktail of monetary inflation and cost inflation deflation, okay? So you can ask the question, what we've had over the last, let's say, 15 years is something like 10% per annum at least monetary inflation per year. In other words, that's the devaluation of the currency. And that's why the gold price has gone up so dramatically, okay? So why hasn't that come through to the high street? That's a puzzling question. Why haven't we had 10% CPI inflation? Well, some people, of course, may argue that we had in places, but the reality is that what's got in between that is costs. There's been cost deflation. Now, what has caused that cost deflation? Well, technology has been one great example of that. The other is cheap Chinese goods. Basically, when China entered the World Trade Organization, when it started to flood the world with cheap goods, that was something that really affected the high street significantly. An awful lot of stuff we still buy from China. But the fact that China came into the world economy with a vast labor force that had such low wages meant that Chinese goods were very cheap. And that meant that high street inflation wasn't that great. Now, if you start to move away from goods and you start to look at services, and you start to look at services surrounding things like real estate or whatever, you'll find the inflation rates were much, much higher among those selected areas. So they are much more responsive to things like monetary inflation, and asset prices are almost totally monetary inflation led. So you can see why you see this sort of spectrum of different price rises. And things that are made in China are not going to go up a lot, but certainly until recently. Things that are technology influenced are not going to go up a lot. So the real price of a computer has clearly dropped. The real price of an iPhone, well, actually probably not. Actually, it's a bad example of the iPhone, but the real price of other technology has dropped. But you can see the point, and that's pretty much where we're heading. So you're going to get a lot of monetary inflation. Question is, does that feed through to the high street? Not necessarily, depending on that cost inflation backdrop. If you get oil prices collapsing, that's clearly going to be a negative on the high street, and that will cause high street inflation to be less than monetary inflation. If, on the other hand, you get this reverse cocktail of more expensive Chinese goods, of a deterioration in technology, and you get oil prices spiking, then you're going to get a lot more high street inflation.
Mm-hmm. Sorry, I misspoke. High Street is like it's the British equivalent of our Main Street, not Wall Street, guys. High Street equals Main Street. I know we mistranslated over here. Yes. Okay, I want to go back to your comments around the Federal Reserve. We just had the FOMC last week, and as you note, it was a hawkish cut, the 25 basis point cut. I want to just dig in a little bit more with you on the Fed. And I guess does the Fed really matter here if it seems like it's the Treasury that's running the show, or as you put, like the Treasury QE, if you will?
Yeah, I think it's a fair point. I mean, there's been a lot of debate about Fed independence. I mean, the Fed and the Treasury are joined at the hip anyway. I mean, if push comes to shove, they act together. There's no question about that. So is the Fed really independent at the end of the day? I mean, I would scratch my head. I don't think the FOMC matters that much. I think the Fed matters a lot as an institution. The FOMC, I think what differences interest rate moves really make. I mean, no one's using that interest rate really to price things off. It's more a sort of signal of sort of general intent by policymakers, I would argue. And I think the only role it really plays is that it may affect foreign investors much more in the US. And if the Federal Reserve is seen to be aggressive in cutting rates, that may well have a negative effect on the US dollar. But I think that's what they want. So, you could argue that this shift towards front-end financing of the deficit through bills and the desire to get the dollar down is why the president is putting a lot of pressure on Jay Powell to cut rates. It makes huge sense. I think they want a lower dollar because that's whole part of the Make America Great agenda. They've got to get manufacturing back in. And I think if you want a parallel, my parallel is the other big anomaly in markets in the last few years is the Japanese yen. Why is the Japanese yen being so weak? I mean, no one really has predicted that. Economists are saying it should be way stronger on PPP basis, but it's not. And I think this is a deliberate attempt by the Japanese, maybe in cahoots with the US Treasury, to basically to make it Japan great again as a bulwark against a regional bulwark against China. And after make Japan great again, it's make America great again. So get the dollar down. First the yen, then the dollar. And I think that is the way to counter a threat from China.
Interesting. I had not heard it articulated like that.
How Europe fits, anyone's guess. I mean, badly is the answer. But then you've got to go back to the 1930s and say, well, isn't that exactly what happened to France in the mid-1930s? Is that they refused to devalue the franc against gold. And they had a too high exchange rate. It devastated the French economy. And, consequently, the French middle classes welcomed the Germans in because they thought they were going to get monetary stability. And, draw the parallel here with if the euro is overvalued for so long against a competitive dollar and a competitive yen, what happens to the European economy? And let's extend the analogy unfairly and say, well, okay, is Russia a threat on the East to Europe? I mean, these are geopolitical considerations. But what I'm saying is you got to think geopolitics, not economics anymore.
That's so okay. Okay. So you need to look at it through a lens of geopolitics then. Okay. Let me ask you this though. The weaker dollar, or I guess intentionally wanting to weaken the dollar, what are the implications? Can you just kind of tease it out a bit more for me?
Well, the implications are that you want to own gold and you probably want to own Bitcoin. Certainly you want to own Bitcoin for the longer term. Bitcoin we know is more volatile, but I mean, these are monetary inflation hedges. And that's what I would argue is basically going on. But, it's not only, a weaker dollar that is driving the gold price. I think China has a lot to do with that as well, which we can get onto. But the implications are that, basically a weaker dollar is, not necessarily bad for the world economy, let's say. It may all be instrumental in causing the world economy to strengthen. It will certainly lift commodity markets. I mean, that's one of the other things that you're seeing. And of course, things like gold miners, which have been, as I say, on a roll this year, are highly leveraged to the gold price.
I'm gonna have to do an episode on gold miners because people keep asking about it too. All right, so I guess like China's been buying a lot of gold too. Like, what do you make of like what we've seen from other central banks buying gold? Does that tie into this thesis as well? What is going on there?
Yeah, it ties exactly into the thesis, because basically, why are these governments buying gold? Because they don't want to be sanctioned in the event that there's further geopolitical strains, and gold is a neutral asset. So, if you hold the dollar, you've got that risk of being sanctioned. If you held the euro, America would make sure that the Europeans sanctioned the countries. So gold is the way out. Now, it may well be there's another agenda there, which I don't know about. And that other agenda could be, for argument's sake, that China et al. Is trying to create a rival to the US dollar system. And that will be partly backed by gold. That's possible. But I think that, my view is that China is just doing a straightforward monetization here to get out of their debt problem. And I want to show that, because I think this is an important point in understanding what's going on. And the chart that I just put up is the rival to the earlier chart I showed of the debt liquidity ratio for the advanced economies. This one's for China, right? Look at the difference. It's almost the mirror image. China has a very high debt liquidity ratio, and that very high debt liquidity ratio has put huge strain on the Chinese financial system, because debt, as we know, China is saddled by lots of debt, has really been choking the economy, and it's been very difficult to refinance. Now, China, through that period, has been trying to keep the yuan stable against the US dollar on what has been, through most of the period, a very strong US dollar. So they've had to tighten liquidity. So in other words, debt has gone up, liquidity has come down, and the debt liquidity ratio has shot up above its normal level. And that's the problem. What China has to do is to get that debt liquidity ratio down. Now, it will do that by expanding liquidity significantly. But as I said, it's been sort of stuttering in that process because it wants to keep the yuan, the paper yuan, pretty stable against the US dollar. So maybe the avenue they're using is the gold price. And that's what we've got to start thinking about. Now, first of all, what is China doing through liquidity? This is the changes in PBOC, the People's Bank of China's liquidity injections over the last 5 years. And you can see that recently it's spiked up significantly. So China is easing. Now, what is the evidence of that in the markets? Number one, you're looking at the Chinese government bond market breaking out in yield terms. Yields are starting to climb significantly. In other words, Chinese investors are switching out of bonds into equities, and the Shanghai market has been on fire. It's been one of the best performers this year, and it's still very well underpinned by this liquidity backdrop. In fact, so much so the Chinese authorities are thinking of putting, constraints on the market to stop, excessive gains. But, we have clearly still a lot of liquidity support in the market. Now, that liquidity is basically driving the gold price up. And I don't think that it's necessarily the London gold market and Western buyers that are driving the gold price. I think it's Asian and Chinese buyers. And you've got to think of that in terms of what's happening to the yuan gold price. Now, we said last year, as a first step to getting out of the debt problems that China has, it has to let the gold price in yuan terms hit around 24,000 yuan or renminbi per ounce of gold to just simply begin to get out of those debt problems. In other words, to devalue those debts against paper money. So in other words, you're devaluing your paper money. In other words, you're trying to improve the real value of the asset. And what that is telling us is they've got there now. We've stabilized for a few months, and now the yuan gold price is going up again. And I think they're going to have to move it up significantly, maybe by another 20% or so. So you're looking at a significant increase in yuan gold. And I think this is the driver of gold prices worldwide. But hey, let's see. But what does it mean generally? It means generally that if China expands liquidity, which is what this chart is illustrating in orange, this is the injections of Chinese liquidity. And, make no question, it's been volatile of late. So it's difficult to predict these things, but they've had this sort of stop-go policy, but it's now clearly go. And the black line is commodity prices, including energy. The dotted black line is commodity prices excluding energy, so not a great deal of difference. The orange line is Chinese liquidity, and the orange dotted line is our projections about what's going to happen. So we think you've got a situation whereby commodity markets generally pick up, completely consistent with this monetary inflation framework, completely consistent with the idea that gold goes up substantially more. But it's China that is also helping this process. It's not simply the fact that federal debt is expanding. This is happening at the same time. You've got two big drivers here of the gold price.
I have to say, Michael, I always love having you on this channel. I know this audience loves having you on. Before I let you go, I want to give you the final few minutes here to leave this audience with some parting thoughts. Anything that you would like to leave with them to think about. It could be something we mentioned in this conversation. It could be something that didn't come up that you would like to bring up. And of course, let them know where they can find and support your work, whether it's your book. You have a wonderful Substack. Anything that you'd like to leave with them, the floor is all yours.
Well, great, Julia. It's been a pleasure. Thank you. I think the first thing is that if you want to follow what we do, the Substack called Capital Wars is probably the best avenue. We have an institutional service, but that is really focused on data provision for quant funds, etc. If you come back to the narrative of what we've been saying, I think that the two takeaways are, number one, we're late in the liquidity cycle. It's about 35 months old since the beginning of the pickup. And they don't really last. Cycles don't last a lot longer than that in terms of the upswings. So we've got to be careful that we're coming to the end. And in terms of understanding the longer term picture, what I would do is to think to geopolitics and what is going on. And what we know is that basically federal debt, as a sort of complement of the whole idea of making America great again and challenging China, has to expand. It will do. But as that expansion goes on, the gold price must go up. And you want, as a core holding, strategically, monetary inflation hedges. And that's the one thought you've got to leave with.
Michael Howell, CEO of CrossBorder Capital, thank you so much for being so generous with your time, all of your knowledge, your wisdom, your amazing charts. We always love having you on this channel. Really, really appreciate you. And until next time, be well. Thanks so much, Michael.
Thank you, Julia. Enjoyed it. Thank you.